DSCR loan rates and conventional mortgage rates barely moved this week. The 30-year fix nudged up just 2 basis points from 6.41 to 6.43%, leaving DSCR loans rates in the high 6s, low 7s range for most investors. 2 basis points, that's it. But here is what that flat line is hiding. The housing market is quietly shifting beneath the surface in ways that could hand disciplined investors a real edge right now, and most people aren't paying attention. Stay until the end. I'm going to show you exactly how using an interest-only structure can lower your effective DSCR loan payments and unlock deals that wouldn't otherwise qualify, even with rates stuck in the mid-6s. The job number that is keeping rates frozen. Why? A strong economy is your biggest enemy right now. On March 19, the Department of Labor reported initial jobless claim for the week ending March 14 came in at just 205,000, down 8,000 from the prior week, and well below levels that would signal any stress in the labor market. That 4-week moving average is sitting at 210,750. Translation? Americans are employed, paychecks are coming in, and the Fed has absolutely no reason to cut rates anytime soon. Here is why that matters to you as a DSCR investor. A healthy labor market sounds like good news, and for your tenants, it is. Steady employment means rents get paid, vacancies stay low, and your cash flow holds up. But it also means the Federal Reserve is perfectly comfortable keeping its foot on the brake. The bond market is reading the same data and keeping treasury yields elevated, which is exactly what is holding mortgage rates in the mid-6s. Anyone waiting for a dramatic rate drop as their entry signal? This jobs report says that window is not opening this week. The quiet market shift sellers don't want to notice. Why flat rates are changing the game. Reports from outlets including Redfin and major financial media are showing something interesting. More sellers are coming to the market. Buyer traffic is cautiously active, and the conversation is slowly shifting from a stilled market to a more balanced environment, even with 30 years rates holding above 6%. For real estate investors using DSCR loans, this is a meaningful development. When rates were plunging or surging, every headline was about financing costs. Now that rates are range-bound, the focus is shifting to deal fundamentals, cap rates, property performance, rent levels, and seller pricing expectations. Sellers who were holding out for a rate cut fueled buyer frenzy are starting to recalibrate. That means you may find better entry points, more realistic pricing, and sellers who are actually motivated to negotiate. That's great news. Not because the market crashed, but because patience is wearing thin. This is the kind of quiet, under the radar opportunity that DSCR investors who stay active in flat markets capture before everyone else notices. The major economic indicators, what is moving markets this week. Initial jobless claims came in at 205,000 for the week ending March 14, down 8,000 from the prior week. Labor market resilience with no signs of deterioration keeps the Fed comfortable staying patient on rate cuts. Your move: stay patient or start working deals now. Here is the strategic reality of a flat rate week like this one. The investors who win in a range-bound market are not the ones waiting for rates to fall. They are the ones who get their deals structured correctly while everyone else sits on their hands. When rates are moving dramatically, urgency drives decisions. When rates are flat, discipline and deal quality separate the smart investors from the ones who either overpay waiting for a better market or do nothing at all. The March 2026 housing market is quietly becoming more favorable on the acquisition side. More inventory is trickling in, seller expectations are adjusting, and the DSCR loan product itself hasn't changed. You still qualify based on property cash flow, not your W-2s or tax returns. If a rental property pencils at today's DSCR loan rates, it pencils. Don't let a 2 basis point week talk you out of a good deal. Now let me unpack the strategy I promise you. Use an interest-only option when it improves your DSCR. Here is the insider most investors overlook. On a DSCR loan, your qualification is based on the property's debt service coverage ratio, which compares the monthly rent to the monthly mortgage payment. If you switch to an interest-only structure, your monthly payment drops, your DSCR ratio improves, and deals that were borderline suddenly qualify, and qualify at better pricing. On a $400,000 loan at 7.25%, the difference between a 30-year amortizing payment and an interest-only payment can be $300 or $400 per month, which can move your DSCR from 1.1 to 1.2 or higher. That single structural decision can be the difference between a deal that gets priced as a marginal file and one that gets priced as a clean, strong loan. If you want to explore other strategies that work better for your specific situation, call or text me directly. Our information is in the description below, and I will walk you through exactly how to position your next deal for the best possible pricing. And just like that, this is already all news. Thanks for watching. If you found this video helpful, give it a like and subscribe for more expert insights on real estate investing. If you are ready to take the next step or have questions, call or text me at 718-300-3503. I'm here to help you understand the market, find smart loan options, and turn today's challenges into tomorrow's cash flow.
If you want to learn how to use financing to grow your portfolio, check out my DSCR Loan Tips and Tricks playlist. Inside, you'll find powerful strategies, lender insights, and real-world tips to help you close more deals and maximize your cash flow.